the MACD. To our knowledge, Peter Horlin was the first to use exponential smoothing for tracking stock prices. Horlin, a rocket scientist who worked for JPL in the early 1960s, used the EMAs for storage of trajectories as they only required 2 integers instead of all previous numbers. The system became known as the Horlin Index, a method to trade the New York Stock Exchange advances via determining market breadth. Described as trend values instead of today's EMAs or mathematically correct exponentially weighted moving averages, EWMAs, they were described by their smoothing constant. Later, MACD was conceived in 1977 by Gerald Apple, an acronym of Moving Average Convergence Divergence, developed as a quality indicator that would be readily interpretable, that would not create so many whipsaws as to be confusing, and that would still be relatively simple to maintain. An oscillator, positive numbers indicating bullish action while negative as bearish action. The function of 2 exponential moving averages, its simplicity makes it extremely adaptable. Paired with a signal line, typically a 9-period moving average of the MACD, the crossover signals a change in trend. The basic interpretation is to trade the crossover of these 2 lines, its popularity being that it can be quickly used to identify short-term trends. Later, the MACD histogram was developed by Thomas Asbury in 1986 as an overlay to the MACD. The histogram being the difference between the MACD and the signal line, much like the MACD itself being the difference between the 12 and 26 EMAs. Used as a method to predict upcoming crossovers, it can also be used to detect hidden divergence signals. 2 peaks are observed on the price, the second peak higher than the first. On the MACD, however, the second peak is lower than the first. This is known as a hidden bearish divergence. During a bearish market, similar logic can be used to find hidden bullish divergences with a lower low on price and a higher low on the MACD. In layman's terms, the second peak, while a higher price, was not as strong a movement as the previous peak with the smaller spread between the leading MACD and the slower signal line. In this sense, the MACD histogram is an interpretation of the market strength in either direction. But like many indicators, timescale heavily affects accuracy. As a rule of thumb, the shorter the time interval of the candlestick, the lower the accuracy of the MACD. In addition to frequent and false signals during market consolidation, it does not provide a reliable binary signal. Using a threshold to avoid trading range-bound markets will simply make the trader chase the market. Using conjunction with price support and resistance levels, a stop loss can, however, mitigate a lot of the risk. These downsides relegate the indicator to higher timeframes only. So over to you, is it TA or tea leaf? The MACD. Thank you very much for watching, and cheers.